Today on the workshop, some thoughts on the Fed's rate cut yesterday, and a look at a viewer question on iron condors, which is kind of interesting. After the bell. Look at this. What? Okay. All right, crazy. But Jason, what do you notice about Mark? A, he's not moving. It's not really Mark. It's a mannequin. And B, he's in a different locale. Look at the background now in the wine cellar.
You know, we just went from like books and intellectual to a lot of wine.
A lot of wine. Look at that. Tell Mark.
Let's be real. That's the real studio. This is where I'm really at. This is who I am.
And that's a good point.
I got one question. Mark, can you pull out your best bottle of wine?
I can't reach it right now, but I do know where it is. I'm pretty sure I know where it is.
Interesting.
It's in a box over there.
Okay. Well, just give me a flavor. I know wine pretty well, so go ahead. Lay it on me. What do you think?
Probably it's either some newer DRC that I have or an 82 O'Brien, I would say, are my tops.
Can't go wrong with either. Domaine Romani Conti.
Tout à fait.
I went out with these two once when they were drinking wine and spirits, and I just sat back and I said, they will order for me. I have no idea what you are talking about.
Give the wine list to one of the two of us or both of us. You'll not go wrong, except it'll be expensive, most likely. Right?
Well, the wait staff laughed at me when I did that. Remember?
All good. So Mark in his studio.
We had a Morgon Beaujolais, I think, at that dinner.
It might have been. You're right. So great background, Mark. I know what's coming there. We'll talk about that someday. But I love it. I love the background. Okay, let's get started. Rate cuts. That's kind of on everyone's mind. You know what I notice about the Fed day, which I kind of don't like, is that it's a sleeper until they make the announcement, which I get it. It makes sense. No one's trading at all. It's really quiet, and all of a sudden it springs up. But yesterday, what was the daily contracts, however, option contracts, system-wide? Anyone have a guess? And I'll give you a hint. Average is in the 55 million range-ish, give or take a few million. What do you think it was yesterday? Which kind of surprised me.
I think it was less.
Answer, so, yeah.
What'd you say?
Go ahead, Jason. I know the answer. I looked this morning.
I don't know the answer in particular, but I would say 40 to 45.
Well, and I kind of tricked you because I said that it's a slow sleeper day, and you're probably thinking, oh, the Lexus thinking it was a really low day. It was actually more like 71 million, right, Mark?
Oh, wow.
Yep, that's what I saw.
Which means that volume really escalated after that announcement. It just cranked. And I think so. I wasn't in front of the markets yesterday, and I think what happened was after the announcement, we initially flew higher. Is that correct? And then we sold off. So, yeah. What I got out of it is, obviously the Fed cut 25 basis points. Target range is now 4 to 4.25. So, maybe two more cuts coming potentially is what they said. So they are getting pretty aggressive. Obviously, it's all data dependent, right? Because they don't want inflation to pop its head back up, clearly. So they've got to watch the signals as well. What were you going to say, Jason?
So the biggest thing I think, other than the two cuts, because that's the median, but the spread, the range of the way the dots were laid out, and the dot plot was a lot wider than a lot of people expected. There were some Fed officials who thought there should be no more cuts after this. Yep. And there were some that were saying, two cuts. There was that one rogue dot, which guess who he was, that was saying 50 bips every meeting starting this one.
Yeah, that was the new Fed governor, Stephen Moran, I think it was. Or Moran.
Yeah, who's still holding a position in the White House. So it kind of that one dot down there kind of shows, that rogue dot, a little bit of an outlier, did kind of push the average down a little bit. But it seemed like, a couple of things that were kind of alarming to what Jerome Powell said yesterday. He acknowledged that there's stagflation, because he said that we have upside risk to inflation and downside risk to employment. And that's, even though economic activity is growing, he said that this, it's a challenging situation for monetary policy. And he said that he is going to focus on the unemployment side. So that means gold should go up, equity should go up, inflation will go up. The other thing he mentioned too was the wealth disparity. He said that a lot of the capital infrastructure is being spent on AI, and a lot of the consumption is done by the more wealthy Americans. So like he's acknowledging that there are the haves and the have-nots. There's not really much in the middle. So I think that overall, it doesn't paint necessarily a great picture of the economy, but it paints a kind of a bullish picture fundamentally for equities, metals, any hard assets, anything like that. In 2016, Venezuela had super hyperinflation. I mean, like, 150,000% kind of thing. And the equity markets skyrocketed, more than doubled in Venezuela during that time. Now everybody's penniless, but it's just kind of shows you that equities are a better inflation hedge, pure inflation hedge, than most other asset classes.
Mm-hmm. Mm-hmm. Now, do you guys? Why am I echoing?
I don't know.
Is that Mark? Mark, you might be echoing me.
Why are you blaming me?
I don't know. I just felt like it because you're in a new place and it's probably very echoey. So now, do you guys position yourselves with any special trades that you're doing in pre-Fed announcement days? Are you like hands in pockets, eyes closed, don't guess? What do you guys like to do? And obviously, here in the better part of that is, the retail trader should that person be in the market prior to the Fed? I get it. They're going to have positions on and they're investors in stocks and they've got covered calls. They're not getting out of that. I totally understand that. But is there a position they should be taking on a Fed announcement day, or is it a pretty much get the hands under the rear end?
Well, I mean, if you're taking a speculative position, the one recommendation I'd have is to size down. Size down, fix your risk, and make sure that, by fixed risk, I mean, I like option strategies, but, do an option strategy that you know exactly how much you're going to lose if you're wrong, and leave it at that, that kind of thing. That's, my recommendation. I tend to have some positions on, usually volume based, because then I can kind of see which way the market will, implied volatility is going to come down. And so volume gives me the idea of how much strength will be given to the upside based on implied volatility coming down. And this time it showed a little bit of strength, but a lot, 6,600 starts to push back quite a bit. And I know we're above it now, but this, it kind of starts to show a trend in how to manage the position. But I take my own advice and I size down considerably.
Yeah, sure. Mark, how about you? Any words of wisdom on Fed days?
Yeah, I mean, I think you're exactly right about the long-term stuff, that like trying to trade any long-term position, which should be 90% plus of your portfolio, like you don't want to touch that on Fed days. That's a recipe for disaster. But where you are trading opportunistically, I tend to not just size down, but size down to zero, because I find that like, even if you look at yesterday's action, even if you back tested what it's going to happen on Fed days, we closed down 6 yesterday. It was basically flat. Like you should have smashed every straddle on the board. But the reality of how that plays out is always going to be different. And like, if you remember the tightening cycle in 2022, like we saw a lot of movements on those days. So I very much expect, especially with like a politicized Fed, there to be a pretty decent amount of like volatility to that end result. And like, that's going to cause you to stop loss. That's going to cause you to take profit. It's not just what you see in the kind of end of day results. Like it gets that much harder to trade something intraday. So I say, save it for smooth sailing.
Yeah, I think I agree with that as well. I find that the point you just made about it ended up in a good spot, but you're going to get yourself waggled out in the middle of the day, as you said, right? Because we had pretty good extreme moves, not extreme, but they're big enough to test you, I think, and it is going to probably hit a stop. And now you're out, and you're looking at it at the end of the day, going, "Oh, only if I'd stayed in," that whole game. Which I don't like playing. I agree with that. What about taking the gamma play, okay, and playing for a move? Who cares which way? We just want it to go. Was maybe Jason, this is a little more for you. I don't know, but was implied volatility out of the range that you technically should be buying?
So it was actually interesting because before the Fed meeting, we experienced a lot of increased kurtosis. So the wings were being bid, even though at the money was not.
Okay.
In the options. So you saw, like, if you were trying to play a very long gamma, everybody was, but on both sides, calls and puts. So skew was increasing quite a bit.
Okay, so buying strangle's not so fun. Maybe the straddle a little bit more. Relative value better.
Yeah, if that's the way you want it to go, but straddles tend to have a high risk. So, and we closed -6, so you would have gotten crushed. So,
speaking of, here's my thought on straddles.
Mm-hmm.
I hate buying them, and I hate selling them.
Yeah.
So therefore, I don't trade them. And just for some of the new folks or the beginners, a straddle is simply buying the at the money call and the at the money put, the same strike, same month, okay, or selling it in the case of selling the straddle, right?
Yeah, I quip sometimes that straddles are named after the guy giving you CPR when you put it on.
I just find the straddle the most important device on in your toolbox, as Mark likes to say, for pricing expected moves. But I just find that trading them is not my cup of tea. For whatever reason, I just don't like it. Mark, thoughts?
This is a great opportunity for me to plug what's coming out in the Till tomorrow. So go to the till.substack.com to subscribe and read this. But when you have a straddle on, and yesterday would have been a great example for this, what you want to do is you don't just want to buy that straddle and let it run. If you're a market maker and you don't necessarily have just a straddle position on then, but you want to scalp the gamma. You want to sell a little bit of shares as it's rallying up and you're getting longer deltas, and buy a little bit of shares when it's going down and you're getting shorter deltas. And the question with a straddle is really like, how well priced is that compared to how much gamma can you scalp out of that? How much data can you pay for by trading the stock against that? And what are the right parameters to do that? Should you hedge every 20 deltas, every 10 deltas, every minute, every hour? There's a lot of different, there's a lot of art to how you scalp that gamma. And like I said, I don't know exactly what it would have looked like yesterday, but with a range like that and a flat close, like that's the perfect gamma scalping environment.
Yeah, I agree with that. What's your prescription for when to scalp that gamma? So again, I'm going back to the beginner phase here. So when you're long a straddle, you got long gamma, right? So when the stock runs higher, you're getting longer and longer deltas by virtue of that long gamma. So let's say you're zero deltas to start, and you get to 1,000 deltas. Again, I'm just making that up. How do you look at it? Is it an actual delta number where you scalp it? You mentioned time. You mentioned delta. What else did you mention? You mentioned so one other thing, I forgot what you mentioned, but what's a good kind of rule of thumb, do you think, for a retail person if they're doing that?
Taking my lessons from the market making days, we would think about scalping our deltas relative to the gamma. So the more gamma you had, the more deltas you'd let run, because obviously that gamma is going to change your delta relatively quickly. So, or in magnitude corresponding to the gamma. So, on a back spread where you're long and you get longer deltas to the upside, shorter deltas to the downside, our rule of thumb was usually about 1 times gamma. If you were short, you might want to hedge less because obviously you're going to be selling low and buying high.
Yep.
People would tend to push that number out, maybe go up to like 2 times gamma on the front spread. The risks there are obvious, right? Like if you sell low and it rallies back, you lock in a loss. If it keeps going, you should have sold a lot earlier.
Yeah.
So, converting that to how I think about this, trading from the buy side is I tend to think about that like in terms of my overall position, and think about, if I'm long 100 deltas of stock or like have, that's one contract's worth, I try to keep that in the 10 to 20 delta range. So might let it wiggle down to 80 or all the way up to 120, 90, 110. Something like that seems to be, and like I said, subscribe and you'll read more about all these details tomorrow, but that seems to be about the right delta range.
Gotcha. That's great, great kind of metric. And I think one of the things I find that the retail folks really, really can benefit from, unlike what we did in the pro side, market maker side, is having a set of rules, right? Because once you have a set of rules, you have this play book. And I'm always of the belief that you got to really be disciplined about it, right? You got to take the emotion out of it and play by the playbook, assuming the playbook is good information, right? I love the 1 times gamma, and all that means for the folks is that what Mark said is that if you have 1,000 gamma and you're 1x, meaning when you get to 1,000 deltas, right, which is the same as your gamma, that's when you're going to hedge it, right? Now that's on the long side. On the short side, it might be 1.5, 2 times that gamma number before you take the Band-Aid and rip it off and say uncle on those sort of things. And just for fun, every time I made a negative gamma scalp, buying high, selling low, it was always the top or always the bottom. It's just the way it is, right?
It's your sacrifice to the Delta gods. Like you just have to do something.
Yep. And I can certainly say opposite when I was long gamma and I hit my gamma mark and I sold it. It was always not the top or the bottom buying it. So it's just how it goes. But again, play by the rules and you'll be just fine. Now, next question on that real quick, and then we'll get to the viewer comment. Do you think the retail person is really position trading like that? So that's a very market maker-esque kind of play. Or is a retail person saying, I don't care about gamma, I don't care about theta, I care about price. If I buy the straddle for $7 and it's trading 8, I'm getting out. I don't care what my deltas are. What are your thoughts? Either one.
So I think the retail people are mostly getting an opinion and are trading deltas. They're not trading gamma, vega. Maybe gamma implicitly, but they're not trading vega and theta. They're not really taking that into account.
Yep.
I think most retail people are, they look at, the situation fundamentally, and then they put on a trade based on that. I think, the Fed is going to cut 25 and be hawkish or whatever. I'm going to buy puts or I'm going to sell, whatever. I think, and honestly, that's not as long as you're not over levering, that's not a bad way to do it. If you have an opinion, you can trade it. Just make sure it's very small portion of your portfolio.
Right. Yeah, I think that's right. Mark, I don't know if you have a thought on that or not, but go ahead if you do.
Yeah, I think, I basically divide the world between there's people that are dealers and then there's everyone else. So like retail, everyone's retail. I'm retail. You're like, if you're not actively like providing liquidity, you're essentially retail and you should be trading like an investment structured strategy and you shouldn't be trading like a dealer and hedging your gamma that way. So I think you generally want to think about how that corresponds to the rest of your book and, what your trade plan might be on that, individual position. So buying that straddle for $7 and flipping it out at 8, like cool, $100 a contract, like go buy yourself a bottle of wine.
Yeah, no, I agree with that. I think that's right. I've seen a little bit of the market maker behavior in a retail person before, but it's very rare. It's very rare, and I think you're right. So one of you guys said it. They have maybe a directional thesis on a stock or an index, and that's their game. And if they nail it, so be it. Get out. If they miss it, take your stop and move along to the next one. Right. So love it. Okay. Cool. Here's what I got the other day from a community group. I thought I'd throw this up here. I thought I want to see your take on this one. So let me read it out. So the viewer said, I've tried short iron condors and have gotten cream. Okay, so I'm assuming that of late this person has done these short ones. The market's been moving, pretty wildly of late. Now I'm thinking I should reverse it and go long these iron condors. Is this crazy? So thoughts? Anyone want to tackle that one at first? Okay.
Well, go ahead. Go ahead, Mark. You can.
I'd say go ahead and flip it on its head and you'll learn quite a bit, because you'll also get cream getting long. But I think what you'll discover is that ultimately, especially if you're trading in anything top tier, this is going to be incredibly well priced. To just say, I only want to sell or I only want to buy, you've got to have a little bit more nuance in the strategy. And you're going to get creamed on the short side. You're going to get creamed always going on the long side, because you're going to just end up paying transaction costs, bid-ask spread, all that stuff. Like, these things are incredibly well priced. I mean, my favorite stat is that, like, ever since 0DTE started, like, the cumulative P&L of selling straddles is like less than $100. So, like, whatever side, or buying them is a negative $100. I forget which way it goes, honestly. But like, it's fundamentally, you can't just trade one side or the other. What you need is some kind of indicator, some kind of signal that is saying, now's a short, vol is low. Now's a long, because I think things are going to move, and for X, Y, or Z reasons. So I think have fun going long, but it can't, you can't only trade one side or the other.
Yeah. So I agree with that, by the way. I think that's good advice. And you mentioned implied volatility a little bit. Is there a metric around implied volatility that's useful for going long versus short? And I'm not just saying because implied volatility is low, I should be buying it, and because implied volatility is high, I should be selling it. That might not be the answer, right? It might not be the answer. It might be just the opposite, quite frankly, for the retail person. Any thoughts around, using an implied vol to make your decision?
Yeah, implied vol is of course helpful. Like, it's the principal component of an options price. So people will rank IVs and say, hey, we're in the 90th percentile. But similar to your point, just because it's high doesn't mean it's guaranteed to sell. I like looking at other signals, like how much the market's maybe moved overnight, like what the relative VIX level is here. To the point about the FOMC, that like, no matter what that vol is, having an event like that is going to be a blackout date for me. So I think getting your points of light from a couple different places is only is going to increase the probability of success.
Yep. Jason, any thoughts on this one?
Yeah. So, I mean, first of all, one thing that I hear a lot, and probably that short iron condor person probably heard this, is the romanticized idea of VRP as like, this is the key to all trading, and selling options, because most options expire worthless, and we should be selling options. You'll make a certain percentage. Problem is that if you do that, you could get creamed, right? And I think that understanding market conditions and understanding all of the Greeks and all of the aspects of your option trade is what's important. So, I mean, it's not just a matter of going short iron condors, getting creamed, and then saying, well, let me try the opposite of everything I just did, and I'll make money. It's not like that. It's like the bias where you just decide to do, it's like, what's his name? George Costanza. Just do the opposite of everything you think, and your life will be successful, right? So, I mean, that's kind of a pretty rough idea. Like Mark said, if you just revert things, you're just going to learn different lessons. I think what you need to do is probably take a class outside of the School of Hard Knocks, maybe do a little bit of reading. There's a lot of good option books out there that give you all aspects of the trade to help you plan your trade better.
Mm-hmm. So, yeah, it sounds like there's a little bit of a signal component here. And when I think of signal, I think I call it a thesis, right? My signal is a thesis. I have a belief about something. And my belief might be the market's not going anywhere, or it's going someplace. And, I tend to look at it more granularly in individual names than I do in indices. So I have better theses, just as this is just me, in Tesla, Apple, Meta, those kind of stocks than I do at large in the market. And I don't know why that is for me. I mean, that's just my personality and how it works relative to these signals that I tend to get, right? But I do look at implied volatility a good bit, and I'm not opposed to buying high vol, especially if it's trading higher in the underlying, and I'm not opposed to selling low vol, relatively. So I can go all ways. It just depends on what my thesis is, as you guys have just elaborated on.
Mm-hmm.
So,
Yep, and we have a great comment here from Doug in the comments about how it's also environment dependent too, right?
Yep.
What the overall market environment is going to be. Taking a little bit of that like Garchi type, theory that the future expected volatility is not just what this asset has done in the past, but it's what in market environment it's living in right now. Are we generally low vol grind up, or are we high vol vol? I think the backdrop of what you're trading against is also really important.
Mm-hmm. Yep. Fair. All right, cool. What else we got? Thursday. I'm trying to think. Mark, do we have any announcements? Nothing.
I don't think so. I don't know.
no announcements from Mark in the wine cellar. Jason,
I know about the announcements.
Time for plugs. Jason, a day on
www.vol.land.
Vol.land. Mark,
harvestedfinancial.com or the till.substack.com to read about that gamma scalping.
Yeah, and if any of the viewers want to jump on a call with me, I do them all the time privately. Lex@tradier.com. That's my email. I love giving that because I love getting emails, believe it or not. And then visit us at hub.tradier.com and Smart Options Trader on YouTube, where there's all kinds of cool content. And guess what? There is talk, right? There is talk. So keep your calendars open of having a live summit in New York City in November. So that is in planning phases, and yours truly will be there. And I'm sure Mark will show up because he's close to New York, and maybe even Jason makes the ride up. So
Not that far away.
Not that far away. So stay tuned for that and listen in, because we'd love to see you there. All kinds of cool stuff we're going to be doing at it. So keep that in the back of the mind. Good.
All right,
Mark. What do we have to do for the rest of the week?
Happy trading.
Happy trading. Have a good one, everybody.
You know how the financial world goes. Here comes the buzzkill. Please make sure to take some time to read this boring disclaimer. We will owe you one.